Don't go broke trying to reduce your tax bill to zero. Today, I'm going to explain to you why this would even happen. And I want you to stay all the way until the end of this video so you can listen in on a question that came in from one of my subscribers. Without further ado, let's dive in. Why do some people go broke trying to reduce their taxes to zero? If you've never heard about this phenomenon, then you might not know that you actually can do this. It's possible. After all, for many people, claiming deductions on their tax returns is a straightforward process without a lot of risk, and it usually results in them saving money as opposed to losing it. But that is not always the case. You see, when you start applying advanced tax strategies, things get a little bit more complicated, and there could be a lot more risk involved. Unfortunately, some people do not mitigate the risk properly, and it comes back to bite them financially. In the worst scenarios, people just go broke. So why do advanced tax strategies require more risk? Many of the best tax deductions, many of the best tax credits, they're reserved specifically for business owners and specifically for investors. The government specifically includes these breaks in the tax code to incentivize activities. For example, there are massive tax breaks for real estate investing, oil and gas investing, film financing, and much more. But the government incentivizes these activities because it knows that they are beneficial for the economy and the nation, but they involve more risk. For example, real estate investments can cost hundreds of thousands of dollars to buy rental properties, even millions of dollars. This is a substantial amount of capital, especially if you're taking a loan. Of course, not every single real estate investment works out. In fact, when there is a real estate market crash, such as 2008, a large percentage of real estate investors can get into a massive trouble with their investments. You see, taxes are different than making investments. And at this point, you might be wondering, Karlton, if there is a risk involved with making tax-advantaged investments, then why do people even make them in the first place? Well, there are a number of reasons why. First of all, if you're a high-income earner, someone who's making $500K a year or plus, millions, 2 millions, 3 millions, then you're most likely going to have to pay an extremely large tax bill. I'm talking hundreds of thousands of dollars or even $1 million plus, depending on how much money you earn. If you don't do anything to mitigate this, then you're just giving money, handing it over to Uncle Sam. This is a total loss from a financial standpoint. However, if you use tax strategy, you make tax-advantaged investments, then you might be able to get your tax liability down and keep more of the money in your pocket. What I'm saying is, if you have a huge tax bill, you can basically hand the money over to the IRS, or you can invest in assets that the government wants people to invest in that have great tax benefits. Some people are even able to completely wipe out their tax bills by doing this, and they can keep 100% of the money that would have otherwise been shelled over to the IRS in taxes. So, where do people go wrong? Many people decide that they're going to take on risk and make tax-advantaged investments in order to try to lower their tax bill. But a lot of these people make a number of critical mistakes that create a massive financial headache. Here are some of the most common ones that I've run into when people are making tax-advantaged investments to lower their tax bills. Mistake number one is just not understanding the tax strategy involved. It bothers me, actually. For example, there unfortunately are some people out there who invest in real estate in order to claim depreciation without realizing that land is not depreciable. So they buy a ranch in Oklahoma or Texas that has 80% land value, 20% building value, without realizing that they will only be able to claim depreciation on the building value, which is just 20% of the total purchase price. People who are in these situations quickly discover that the tax deductions that they are eligible for were much smaller than they were hoping for. This can result in them spending hundreds of thousands of dollars and taking on significant risk without even a substantial drop in their tax bill. This is exactly what we do not want to have happen when we invest in assets for tax benefits. In fact, when I have my clients invest in real estate in order to benefit from tax breaks like depreciation, I typically want the properties that they invest in to have an 80% building to land ratio, meaning at least 80% of the property's value is contained in the building structure. That way they can maximize the depreciation deduction on their return. Mistake number two, not caring enough about the actual investment. What I mean by this is that some people invest in tax-advantaged assets just for the tax benefits without looking long enough into the underlying asset to see if it will perform well beyond the tax benefits. An example of this might be investing in natural gas wells without having any idea of whether or not the well will likely to be able to produce gas for you. Not all oil and gas wells are equal, and one well could produce for 50 years, whereas some could produce for 6 months, a year. Some don't even produce at all. So if you invest invest in any oil or natural gas wells, then your investment could perform poorly even though you might get good tax benefits. Throwing large amounts of money into an investment that performs very badly is a good way to go broke, and I do not want this for any of my clients. Mistake number 3. Thinking losses from investments can offset all forms of income. The type of income that your losses can offset depends on the nature of your investments. Just because you invest in a rental property does not mean that you will be able to use your real estate losses to offset your primary income from your W-2 job or your 1099 business. In fact, if you invest in a long-term rental, do not materially participate in the business, and do not qualify as a real estate professional, you will most likely only be able to use your real estate losses from depreciation to offset your passive income. This would include your rental income from the rental property, but it would not include your income from your day job or your business. Now, if you can only use rental real estate losses to offset your passive income, the tax benefits will obviously be much smaller for many people. So don't make the mistake of thinking that just because you invest in real estate, you will automatically get all these beautiful tax deductions that offsets your W-2 or 1099 active income, because that is not the case. Here on my channel, through my tax firm, I teach people how to invest in short-term rentals in order to offset their W-2 and 1099 income. This is because under Code Section 469, short-term rentals with an average stay of 7 days or less are an exception to the standard passive activity loss rules. You can learn more about this tax strategy by just watching my video right here. All right, moving on. How not to go broke investing in tax strategies. Hopefully, after watching this video up to this point, you have realized that making tax-advantaged investments does not automatically lead to powerful tax savings and great wealth. In fact, if you do it wrong, it can be the actual opposite. It can be a money suck. The good news is that there are things that you can do to ensure that you lock in your tax savings while selecting the right investments that will make you money over time. The first and most straightforward thing that I want you to do is to just work with a tax strategy firm that can help you make the right type of investments and implement the best tax strategies. They're not a fiduciary, but they can consult with you. My firm, Tax Alchemy, has helped thousands of people make tax-advantaged investments that set them up to build wealth while optimizing their tax savings. In addition to having a staff, a dozen of highly skilled tax professionals, we also have partners in various industries, such as real estate, who work with our clients to help them find the best investments possible. If you'd like to work with us, click on the link in the description below to book a complimentary consultation. We'd be happy to help. Now, not everyone wants to work with a tax strategy firm. I understand that. Some people prefer to go at it alone. That's fine too. But if you're going to go at it alone, make sure that you're careful in studying all the tax rules related to the investment you want to make. Also, make sure that you do all of your homework on the investment itself to make sure that you won't just be throwing your money away, trying to avoid taxes and going broke in the process. Now, I'm going to answer a question that came in from one of my subscribers, but before I do so, I just want to remind everybody that's watching this video to sign up for my Tax-Free Wealth Challenge, March 10th through the 14th, 2025. It's one of the largest digital tax conferences in the world. Over the course of 5 days, I'll be teaching the absolute most powerful tax strategies that I know. These strategies literally bring your tax bill down to zero or close to it, and the link is in the description if you want to sign up. Now, back to the question that came in from one of my subscribers. This question was asked by Jessica Reed 3458 on my How to Reduce Your Taxes to Zero video. The question was, can you take a tax deduction for the expenses of starting up a B&B? So a B&B, I'm assuming, is an Airbnb. And if you are starting up any business, the IRS will allow for you to write up your startup costs. The first $5,000 of startup costs can be taken in the first year incurred. But if you never start that business and get it off the ground, any expenses in excess of $5,000 have to be amortized over 15 years or written off over 15 years. As long as you've started your business before December 31st, all expenses incurred in the year are deductible in the year, meaning you will be able to write those off. Guys, thank you so much for watching this video. If you learned something new today, go ahead and let me know in the comments. I hope that this video helped you save a little bit more money on taxes. I hope that you also will take the opportunity to join my Tax-Free Wealth Challenge so I can teach you some of the high quality tax strategies that I leverage with my clients. Be sure to sign up before we sell out of tickets. If nothing else, I look forward to seeing you in the next video. Cheers.